Ever looked at a trading floor scene in a movie, the sheer chaos, the shouting, the frantic hand gestures, and wondered, what on earth are those people actually doing? I mean, beyond yelling about numbers? Specifically, have you ever wondered about those folks who seem to be in the thick of it, constantly buying and selling, almost like they're playing a high-stakes game of hot potato with financial instruments? Well, if you have, you've probably stumbled upon the concept of a jobber. But what exactly is a jobber in trading? Is it some old-fashioned relic of a bygone era? Or is it still a relevant role in today's lightning-fast, algorithm-driven markets? That's precisely what we're going to unpack today. Because understanding the jobber, even if you're not planning on becoming one, gives you a fascinating glimpse into the very heart of how markets function. It's like looking under the hood of a complex machine, seeing the gears and levers that make it all tick. Now, before we dive into the nitty-gritty, let's establish some context. Trading, at its core, is about facilitating the exchange of assets. Whether it's stocks, bonds, commodities, or currencies someone wants to buy and someone else wants to sell. But how do you connect those two parties efficiently? That's where market makers come in. Historically, in the days of physical trading floors, this was a much more visible and vocal process. Imagine a bustling trading floor, a sea of faces, and amidst the clamor, individuals known as jobbers. These were independent traders who acted as intermediaries, providing liquidity by constantly offering to buy and sell securities. Think of them as the wholesalers of the stock market. They didn't necessarily hold onto assets for long periods. Their primary goal was to profit from the spread, the difference between the price they bought at and the price they sold at. Let's break that down. Imagine a jobber sees a stock being offered for $100 and someone willing to buy it for $100.10. They might buy the stock at $100 and immediately sell it at $100.10, pocketing a quick 10 cents profit. Multiply that by hundreds or thousands of transactions a day, and you can see how this could be a lucrative, albeit risky, business. The key here is speed and volume. Jobbers needed to be incredibly quick to react to market fluctuations. They had to constantly monitor prices, assess supply and demand, and make split-second decisions. The more trades they executed, the more opportunities they had to profit from the spread. Now, you might be thinking, that sounds like a lot of pressure, and you'd be absolutely right. Jobbers operated in a high-pressure, high-stakes environment. They were constantly exposed to market risk, meaning that prices could move against them at any moment, leading to significant losses. But what about today? With the rise of electronic trading and algorithmic trading, has the role of the jobber become obsolete? The answer is a bit nuanced. While the traditional image of the jobber shouting orders on a physical trading floor has largely faded, the fundamental function they performed, providing liquidity, is still essential. It's just being done in a different way. Today, many of the tasks previously performed by jobbers are now handled by electronic market makers. These are often large financial institutions or specialized trading firms that use sophisticated algorithms to automate the process of buying and selling securities. These algorithms can analyze vast amounts of data in milliseconds, identifying trading opportunities and executing trades at lightning speed. They can also manage risk more effectively than human traders, ensuring that they maintain a balanced portfolio. So, in a sense, the jobber has evolved into the algorithmic market maker. The core function remains the same, providing liquidity and profiting from the spread, but the tools and techniques have changed dramatically. However, the human element hasn't completely disappeared. There are still situations where human judgment and intuition are crucial, particularly in volatile markets or when dealing with complex financial instruments. Furthermore, the concept of the spread, the lifeblood of the jobber, is still very much alive. Even in electronic markets, the bid-ask spread, the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept, is a fundamental element of market structure. 1. Advisors.vanguard.com. Advisors.vanguard.com. Understanding the jobber also helps us appreciate the importance of liquidity in financial markets. Liquidity is essentially the ease with which an asset can be bought or sold without significantly affecting its price. A liquid market is one where there are always willing buyers and sellers, ensuring that prices remain stable and that transactions can be executed quickly. Jobbers, and now electronic market makers, play a crucial role in maintaining market liquidity. By constantly offering to buy and sell securities, they ensure that there is always a counterparty available, preventing prices from fluctuating wildly. Without liquidity, markets would become inefficient and volatile, making it difficult for investors to buy and sell assets. This would ultimately undermine the stability and efficiency of the financial system. It is important to understand that jobbers were also very important for price discovery. Because they were constantly in the market buying and selling, they were able to quickly reflect changes in supply and demand in the prices they were offering. This helped to ensure that prices were always accurate and up-to-date. In the past, this was a very human-driven action, where experience and a gut feeling were as important as any data. Today, algorithms do this at a speed no human could achieve. The role of the jobber, whether human or algorithmic, is a vital part of the financial ecosystem. They provide the necessary lubrication that keeps the markets running smoothly. With that said, thanks for watching, and until next time.